welcome to Ainsley News. It's Wednesday, 26th of May. Gold and silver rally on the reality of what's happening. Both gold and silver had strong nights last night, both up around 1%, while shares and US dollar all declined. As we wrote about it and discussed last week, the Aussie dollar was dropping despite the US dropping as well, meaning we got all and more of those gold and silver gains last night in Aussie dollars. Importantly too, gold broke through the US $1,900 mark, and silver broke through $28, adding key support for further gains. These next two charts we're going to show how technically gold has broken through the 9 months channel of consolidation and now through both the 50-day and 200-day moving averages. Here's that first chart here for gold, showing that breakout here, and also here's those moving averages there for gold too. So what's driving this price action? Frankly, it's likely because even the most willfully blind can see the reality of what's coming, and they're seeking the trade that provides both protection and upside in its conclusion. Real Vision recently interviewed FFTT's Luke Groman to get his take in the self-explanatory title piece called Why Inflation Will Not Be Transitory. It's a long piece, but we'll summarize here. Firstly, the US economy is really, in our view, past the point of no return from a balance of payments perspective, at a time when foreign central banks in particular, are not financing enough of the US deficit. So we start to be governed by the balance of payments math that every other nation on the planet has long been governed by. And once you start applying that to the US situation, there really is one of two outcomes. You either get basically a deflationary collapse, or you get a very secular structural inflation as the currency weakens. And our take is that when you look historically, very few sovereigns with a fiat currency have chosen collapse over inflation when given the choice, and the US has clearly the choice. The US has chosen twice already. And point one, on Monday, we talked about the repo stress that's happening now and getting worse since that of September last year. Groman also writes, we had a choice to finance treasuries at 8%, but the Fed chose to print the money and to get the repo rates back down. Point two, and again last March, of course, in the COVID crisis, we had the choice to let the economy collapse. The Fed chose to implement QE at $625 billion per week and then slowed it from that point. In response to the transitory calls off the back of the speed of the reflation response and how the interruption to supply chains being seen before, he points out that now is very different. What they're leaving out is the context for where we are. We're not at 55% debt to GDP in the United States like we were in 1995. We're not at 65% like we were in 2000. We're not at 80% or 75% like we were in 2009. We're at 130% debt to GDP. US entitlements are cash flow negative and getting more cash flow negative by the day, unlike being cash flow positive all the other times. The US government is 22% or 25% of GDP, way above where we were in those other recoveries. Transfer payments as of personal consumption expenditures, so consumer spending is 35%. So a third of the consumer spending, which itself is 2/3 of GDP, is coming straight from the government. They're just shifting it from one pocket to the other. And the most important structural contextual difference, he says, is that this is the first recovery in 80 years where the foreign central banks are not buying US treasuries on net, and haven't since 2014. What this means is a complete change to the holder of the world's reserve currency and the privilege that comes with it. Simply, historically, the way the world worked is people send us stuff and we send people dollars, and then they reinvested those dollars in the US, which meant we exported treasuries. They sent us stuff, we sent them treasuries. And they're still sending us stuff, but we're not sending them treasuries anymore because they don't want them. They're not buying enough. We wrote of this recently in the twin deficit issues the US currently faces. And so what you end up with is basically the US government being beholden to the same balance of payments math as everybody else. And once that happens, the question is, okay, do we shrink the government? But if you shrink the government at 25% of GDP, you go into a recession. If you go into a recession with debt to GDP at 130%, the treasury market collapses. There's not enough private sector balance sheet to float the increase in treasuries that happens in a recession with debt already this high, with foreigners not buying it, with the dollar where it is. So any recession is a non-starter. You just can't have it. because the Treasury market will break, and the Fed has repeatedly said we are not going to let the Treasury market rate. Groman goes on to state that he does not think the Fed can dial it down a little. At a debt to GDP of 130%, it's a switch and not a dial. They are stuck. To be able to dial it down, they first need to get that figure down to around 80%. To do that would take 20% of GDP growth for 5 years. To do that, inflation has to rip higher. He sees no other way out. That ultimately means deeply negative real rates. To me, the biggest misperception in Wall Street today, by far and away in my view, is that real rates in the United States bottomed in August last year at negative 1.1% on the 10-year. I think they're going to go at least negative 5%, perhaps to negative 10%. And I think they could go lower than that, quite possibly. And I think they need to go lower than that. I think that's what the government wants to decover their balance sheet. So let's assume that I'm right, that it does go to negative 10% on the real rate. What do we want to own during that period? I think you want to own gold, gold miners, Bitcoin, and commodities. Pretty insightful stuff there. Thanks for joining us for news. If you are interested in the physical stuff, jump over to ainsleybullionn.com.au. Cryptocurrencies, jump into ainsleywealth.com.au. Check out our new website and our new dashboard showing all live prices. You can actually switch between any currency on that page as well. Not just the Aussie or US dollar, but you can switch to any cryptocurrency to see the value of any other cryptocurrency. And if you're interested in our own cryptocurrency built and backed by Ainsley Bullion, check out goldsilverstandard.com. It's real gold, real silver, stored at Reserve Vault and built on the blockchain. We'll catch you tomorrow for more news.